So, Chapter 5 introduces us to what's called a merchandising operation, which is any business that sells merchandise. Merchandise is a good, a physical product. And then later in the chapter, we look at a more developed income statement than you've been exposed to already, called a multi step income statement. So, we're going to look at that. Today's lesson solely on objective one, just so you can get we can get our feet wet here. So, like I said, here, merchandising operations are companies that buy and sell goods. So, a good is a physical product, right? And some of the companies on the right are in merchandising. You've probably been to a Walmart before, might have used Amazon. Some of you might not know a company called REI. It's Recreational Equipment Incorporated. It's sort of like a combination of like Dick's Sporting Goods, Modell's, and Cabela's sort of wrapped into one. It's kind of outdoors stuff, but there's also sporting. They don't have any in this particular area, but again, it's more of a retail. How this all works. Now here you look at this chart shows the very end is you and I going into the store, and buying stuff. Okay, sorry if your leg's a little bit shorter than mine here, but so you and I are going to go into stores and buy stuff. But the whole process behind the scenes is really what this is about. The retailer, anybody who sells merchandise to the public, is basically in retail. Okay, regardless how they want to classify their business, they are a retailer. They are selling goods. Again, physical products. They're selling goods to the public. But as you and I walk into their store, you need to know that they first have to buy all of that stuff to put in the store. Otherwise, we're walking into a store that has nothing in it, right? So retailers have to deal with, they used to deal with wholesalers. I think this is more appropriate that most retailers will deal with manufacturers of products. And manufacturers are the folks who actually create and design and make goods, make products that you and I buy. So like Walmart, Amazon, they don't deal with wholesalers. They deal directly with manufacturers. So manufacturers make all that stuff. Again, the very first step in the process is Walmart or Amazon or others are buying the goods to put in their store. Okay. Now, when they buy these goods, they own them. They own them. And this is what inventory is. Now, we've talked about inventory in the past, in the last couple of, the first couple of chapters in the book mentioned inventory. But in essence, inventory is basically goods that are purchased by these retail firms with the intention of selling them to the customer. The retailer doesn't want to own them for a very long time. They want to sell that to the customers. So right away, sorry about that. So right away, there's a cost involved because, like it says here, they have to buy the inventory and put it in the store first. Okay. Then you and I come into the store and buy the inventory from them. We buy the goods from them. So that's why merchandising companies buy and sell goods. They have to buy, put it in their store, then they sell. Now, you and I, when we go into a store, we will see that all of the merchandise has prices, right? So the prices that we pay for the merchandise is to the company their revenue, their sales revenue. And so the word sales is synonymous with the word goods. It means selling of a physical product. So if you see this revenue account called sales revenue, just because you see the word sales automatically relates it to the fact that they're selling a physical product, which is different from Sierra Corporation last chapter, where it was all service revenue. Service revenues, they were performing work, right, in exchange for that. So that's what was going on there. The price that you and I pay is the revenue for the company. Is the revenue for the company. So in essence, the company. This is how merchandising operations sort of work. The retailer has to buy the products and put it in their store. That's their inventory. Then the retailer tries to sell all that to us as customers. That's their sales revenue. Okay. So the price that you and I pay for anything is the sales revenue to the store. So that's an important account to know. So knowing this, they measure their income differently. So the income statement of a merchandising company is a little bit different. They start with revenue, right? But their revenue account is called sales revenue. And like I said, the first thing they do, the purpose of them selling stuff, right? They buy the inventory to resell it. So they collect the money from us. The first thing they do is they subtract out the cost to them. Remember, if you go back to this first slide, they had to buy the inventory first. That cost is important to know. Okay. They buy the inventory first and then they sell it to us. So when they actually sell it to us, the first thing they do, they collect the revenue and then they subtract the cost of that good that's been sold to us. The difference is called a gross profit. Okay. And these are very, very important accounts to understand, to learn. Cost of goods sold is its own account. It's a new account. It's specifically an expense account, well, because it's on the income statement. Okay. So it's an expense account. The gross profit is simply the difference between the sales revenue and the cost of goods sold. Okay. So, for example, let's say you walked into a retail store of your choosing and purchased a backpack for school. Right? And you purchased a backpack for $40. So the price you paid was $40 as a customer. How the business looks at it is they just made $40 of service revenue. Sales revenue. They just made $40 of sales revenue. Okay. The first thing they're going to do is subtract out the cost of the backpack to them. Because again, they had to buy it and then they're reselling it to us. So they subtract out the cost of that good that they sold. Now, let's say it cost them $25. The difference, which is $15, $40 of sales minus $25 of cost of goods sold, $15 is their gross profit. From that gross profit, all the other expenses are paid. And there's a lot of other expenses, right? They're going to pay salaries or wages, they're going to pay rent, they have supplies expense, insurance expense, they have lots of expenses. And that ends up being their net income on their income statement. So look how their income statement's already a little bit different, right? Sales revenue minus cost of goods sold, that gives them a gross profit. From the gross profit, they subtract all the other expenses to find out if they actually made a profit or not. And it's amazing how many expenses merchandising companies have, which is why retail is a very competitive industry. And that's also why you're often hearing about retailers perhaps going out of business, particularly in the last year or so, because they haven't been selling as much. So they haven't been selling their products as often. And so if you're not selling your products, you're not making any money. Okay. Remember that sales revenue has to cover all of your costs, and what's left over is your profit. Everything starts from revenue. So when revenue starts going down, companies end up losing money, and they either have to cover that loss or they decide to go out of business sometimes. The cost of goods sold, as mentioned in the first slide, is really the cost of the inventory that they had to buy. Remember, they have to buy it before they sell it. So they buy it. Inventory is an asset. Once they sell it, it becomes an expense, cost of goods sold. Okay, so whatever the cost of the inventory is, becomes the cost that they subtract out. So very important accounts: sales revenue, cost of goods sold. Very, very important to know those two new accounts. Gross profit is simply the difference between them. So the actual operating cycle of a merchandising company is a little bit more complex. We've been looking at service companies, which basically perform services, and either they get paid cash for that service right away, or they set up a receivable and collect the cash later. Merchandising companies start right away by using their cash to buy inventory, right? Because that's all they do. The entire merchandising business, the entire purpose of retail, in essence, is to sell goods. That's it. That's the whole purpose of their existence, is to sell the goods that are there. When they buy inventory, that is their asset. Okay. And like I said, inventory, you've seen the account before in the earlier chapters. It's a current asset because the whole purpose of the inventory is for them to sell it. They want to sell it quickly. Okay. But it starts off as their asset. Once they sell it, it turns into the expense called cost of goods sold, which you just learned about. So they sell the inventory. Most of the time they'll sell it for cash. On occasion, they'll sell it on account, usually when they're selling merchandise to other businesses. And thus they have to collect that, and it goes back. As soon as they get the cash, the cycle starts again. They're buying more inventory, because that's how they make a living, selling their goods, selling their inventory. So keeping track of inventory is important, okay? The first thing they do at the beginning of a period, say the beginning of the year, is they'll find out how much inventory is already in the store at the start of the year. So step one is they're going to look at what's in the store. Step two is they're going to go and buy more inventory, right? So the cost of that inventory is the very next thing that's going to happen. So they're going to take their beginning inventory, whatever they spent money on the beginning inventory, and add all the costs of the new inventory. And that gives them here step three, which basically is this is all the money they spent on inventory available for sale. Now, the very important thing to know about inventory from an accounting perspective is only two things can happen to inventory once you own it. Okay. You either still have it at the end of the period, which means it's still your asset, inventory. Or if it's not there, we assume you sold it. We assume you sold it. Okay. And that's the only two things that can happen to inventory. Once you actually have the inventory and it's all available for sale, at the end of a period of time, you'll count what's there. That's your ending inventory. Clearly, you still own it. And if it's not there, there's an assumption that you've sold it. And if you sold it, you'll have a cost of goods sold. So again, inventory, asset account, cost of goods sold, expense account. Okay. Very important to understand. Okay. How do companies keep track of all of this? Well, many companies work under what's called a perpetual inventory system, which means that they continually track inventory, which is easy to do because if you have a computerized inventory system, it's easy to track your inventory. All your inventory has barcodes for a reason. It's to help keep track of inventory. So when inventory arrives at the store, oftentimes it's being scanned in. So you'll see people who are receiving inventory, they're scanning it, you know. And then it's scanned on the way out as well, because either whether it's self-checkout or the cashier is doing it, you're going to get to the register and you're going to hear the same thing, boop, 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 all the time. That's basically recording a lot of accounting with that little beep. Sounds like a little beep. Sounds annoying. But that little beep is recording the sales revenue and the cost of goods sold. That little beep is also recording the fact that you have less inventory because the customer just bought it from you. Okay. And that's important to know. And when that's done by computer on a continuous basis, that's really what the perpetual inventory system is. Most retailers are so huge, they are all using a perpetual system. However, you have, and particularly back in the day when I was a young man, you had something called a periodic inventory system. You still have it. And this is why, where you physically count the inventory at the end of, say, at the end of every month. You physically count the inventory in the store. And that's how you keep track of filling in the blanks here in this chart. And so that's important to know. But the periodic inventory system is still used by everybody, even those that use a perpetual system. So even though they're continually tracking inventory, guess what? At the end of a period, they got to make sure. And the only way they make sure is physically counted. So even companies that use perpetual systems will pick a time where they're physically counting, which is in essence what the periodic system does. Now remember that chart earlier that I showed you with those boxes. This is how it would play out if we looked at it. So if we started with inventory of 100,000 already in the store, and we bought $800,000 more of inventory, we would have a total amount of inventory for sale that year of $900,000. Again, only two things can happen to it. It's either still with you. If it's not, we assumed we sold it. So we count what's still with us. Ending inventory is simply counting how much inventory is still in the store with us. That's our asset. The difference, we assume, has been sold, which means the cost of goods sold is our expense. So this is basically a table form for what was earlier that chart of boxes I was going through with you. Okay. And that's basically the introduction to merchandising here and the inventory systems. And there's a few true false questions that are here for us to look at. One is the primary source of revenue is performing services. No, we're selling goods. That's why it's false. The primary source of revenue for a merchandising company is sales. Sales. The operating cycle of a service company is shorter than merchandising. Yeah, merchandising is more complex, a lot more going on in that cycle. So this is true because the service company simply has a shorter cycle to deal with. Sales revenue minus the cost of goods sold equals the gross profit. This is true. This is actually something that you have to know. I don't actually require you to memorize much, but this is one of those things that you really need to know by heart because you're going to see it over and over again. Okay, so sales revenue minus cost of goods sold gives you the gross profit. That's very important. And lastly, here it says your ending inventory plus the cost of all the goods purchased equals the cost of all the goods available for sale. That's false because it's not ending inventory, it's the beginning inventory. So your beginning inventory, which is already in the store, added to all the goods you're bringing into the store, gives you the cost of all of your goods available for sale that period. Okay, so that's why that is false. That's the introduction. I just wanted to do an introduction today. We're going to get into more detail, certainly next class. But any questions on that so far?